Welcome back to NTV Tonight. Now, what does Donald Trump's win in the U.S. presidential election mean for companies that operate globally? A sit-down with Standard Chartered Bank's Global Chief Executive, Bill Winters, paints us a picture of what we should be expecting, especially in the finance sector. Here's Nina Shaban with this week's episode of On the Money.
So, first of all, welcome to Kenya, Nairobi to be precise, and thank you for giving us this opportunity to have a sit-down with you. So maybe we can start off with, what is the purpose of your visit to you and the entire board?
Well, we have a number of objectives, I think, with this trip. I come to Kenya regularly. Kenya is a very important market for Standard Chartered Bank. Nairobi is, of course, our hub in Kenya. So I get here typically once a year, sometimes twice. I always find it refreshing to come here because we have an excellent team they're doing very, very well. Of course, the country has had problems, and we've had our own share of problems ourselves. But we managed to work through them, and I think in a highly cooperative way. So for me, when I visit, I want to check in on the team. Of course, I want to check in with the government. We had the great honor and pleasure of meeting with the president yesterday, who shared his views on both how the economy is developing in Kenya and the plan, but also how we can help in the most effective way. But this is a particularly special trip because we are holding our board of directors meeting here, so our group board, which travels outside of London a couple of times per year. The last time we had a board meeting in Nairobi was in 2016, so it's been 8 years since the board met here. For some of those directors, it's their first visit to Kenya. For many, they've been here either professionally or personally. But what a fantastic time to be in Kenya and to showcase this outstanding franchise that we have in this outstanding market. This is very exciting all around.
All right. Now, I'd like for us to look at Africa as a whole. So what trends do you believe define Africa's economic outlook in maybe, give or take, the next 5 years?
You know, it's always hard for us to look at Africa as a market. Of course, it's not a homogeneous market. Maybe one day it will be. We heard from the Secretary of the African Free Trade Agreement, Free Trade Zone, last night. So we know that that's a very active work in progress. But of course, the markets are homogeneous. That said, there are some common challenges. Say debt sustainability has been a challenge across a number of countries in Africa. The spike in inflation, which obviously hurt the consumer, hurt the economy in real terms, also led to higher U.S. dollar interest rates and a stronger U.S. dollar, all of which is very bad for countries that are struggling with a relatively high level of U.S. dollar denominated debt. So Kenya was included in that, but I have to applaud the central bank and the government for navigating through that challenging time, taking the painful actions, or recognize these are painful things to do, but necessary and effective, and I will say working as a practical matter. That is unfortunately a common feature across a number, not every, but a number of our markets in Africa. But beyond that, things diverge. Of course, we've got some markets are commodity exporters and some are commodity importers. The price of oil has actually remained relatively subdued. So energy costs for those countries that are more dependent on imported oil or imported energy have been able to make it through this okay. Kenya, of course, is relatively less dependent on imported fuel because of your extraordinary renewable capabilities. But looking across the continent, I think we see some consistent challenges in terms of market access for international investors, and also the attractiveness of foreign direct investment because of some of the local blockages to new investment capital coming in. So part of what we do with our clients here in Kenya is to talk about how we can make Kenya an even more attractive destination for external investors to come into the country, both financial investors but also strategic investors, so investing in key industries. How we can advance the development of the power sector in Kenya, which is both a primary generation consideration, tremendous natural resources, but there's also a growing need for power, but also the transmission, which is frequently the bottleneck for really getting industry in place. It's not just the power itself, but getting the power to the right place. So these are the sorts of things that we're working on in Kenya, very consistent with some of our areas of focus across the continent.
We have just seen Trump win the elections, President Trump, to be precise, and amid the ongoing rate cuts in the U.S. and other major economies, I mean, how do you see these two events affecting capital investment flows into emerging and frontier markets?
Yeah. Obviously, the market is still trying to figure this out, and we'll have to see how the policy enactments follow not until he takes power, but in January we'll start to see how much of what was described and discussed on the campaign trail gets translated into concrete actions in the real world. What we've seen in terms of immediate market reaction was a few things. One is long-term interest rates have gone up significantly. So, not significantly, they've gone up by 15 basis points. But that's a lot for a one-day move in 10-year U.S. government bonds. Why is that? Because the view is that the Trump policies are likely to be relatively inflationary. And that could affect the Fed decision-making in terms of how they adjust short-term rates. So the Fed is expected to reduce interest rates by 25 basis points. That's what they've been signaling for some time, and that reflects the fact that inflation has been coming down. Now, I don't think anybody has recalibrated their expectations for this week, but the recalibration over the next 2 years is happening real time. So what does that mean for Kenya? Well, the higher U.S. dollar interest rates will typically mean a stronger U.S. dollar, and we've already seen that. The dollar strengthened yesterday on the back of the election results and has stayed strong. So we're back into putting a little bit of pressure onto the economies that have struggled with higher U.S. dollar interest rates and a stronger dollar. So I think that, unfortunately, I think for many countries in sub-Saharan Africa, including Kenya, is an incremental headwind. The flip side is that U.S. equities rallied. In fact, global equities rallied substantially yesterday. And that is the view that along with the reflating or the inflation in the U.S. economy will come stronger growth. And with stronger growth comes more capital investment. I think there will be a scramble to attract that investment into your various locations around the world. Clearly, the Trump policies are much more oriented towards growth in the U.S. and capital investment in the U.S. We'll see what happens with the indicated increase in tariffs across the board. 10% is the number that's been mentioned. Particularly higher tariffs on China or Europe or Mexico. We'll just have to see how the campaign rhetoric translates into reality. But if the bulk of the capital is effectively targeted into the U.S., because that's the way the tariff system is orienting things, then the rest of the world might not benefit quite so much from the economic growth that we're seeing or expecting to see in the U.S.
Well, it's a wait and see. Now, will you continue the strategy of divesting from some of the African markets to focus on higher potential markets in Asia? And how will Kenya be affected?
So what we've been doing is really focusing in each of our markets around the world on where we are adding incremental value to our customers, to the local economy, and of course to our own shareholders. And the consequence of which was that we have exited, or in the process of exiting, a number of onshore markets in Africa. They tended to be smaller markets, and each one had its own dynamic. In Angola, we had a 45% stake in a joint venture that we sold to our joint venture partner. In Zimbabwe had a particular set of considerations around currency controls and the like. Some of the other markets were very, very small. Part of what we've been doing on the flip side of that, though, is investing. We've invested in our digital capabilities in Kenya. We've been investing in our capacity to deliver public-private sector blended finance, in particular in the sustainability or renewable power sectors in Kenya and other larger African markets. We achieved very strong financial results in Kenya last year, and we're continuing to invest into that strength. So Kenya to us it's a key market globally, and it's a key market in Africa. We'll continue to fine-tune this portfolio. Now, we announced just last week that we sold a part of our personal loan and credit card business in India. Now, India is a core market for Standard Chartered Bank. It's the largest employee base for us is in India. It's a very, very strong franchise, been around for a long time. But even within that very strong franchise, there are things that we can do very well. We can serve large corporations, financial institutions, international companies operating in Kenya or India. We can do that very well. And there are other things where we are less differentiated today. Mainstream, branch-based, mass-market banking is probably best left to local players who have well-established branch networks, very strong brands, and these days, very strong technology as well. So we continue to refine the portfolio, but 100% committed to Kenya, 100% committed to Africa, and we're committed because it's a good franchise for us. We generate good returns with good growth, and we've got a very differentiated prospect and set of operations here.
All right. So your bank has been going big on wealth management services in Kenya, and meanwhile we have seen JP Morgan Chase, who recently opened a representative office right here in Nairobi, and they avoid wealth management and instead focus on investment banking. What have you seen that they haven't?
Well, we've been in the retail business in Kenya for over 100 years. So we know retail banking extremely well. We have a branch network. We were, I think, pioneers or have been pioneers in the wealth proposition because Kenyans are accumulating savings. And that wasn't always the case, but it is now. And we want to make sure that this rapidly growing middle class in Kenya, and of course people who have accumulated more savings, have a range of things into which they can invest. Now that always starts with financial literacy. So let's just make sure that we understand when you've got your savings pool, what are you saving for? Is it for your children's education? Is it for your retirement? Is it to pass on to the next generation? Because that will then inform what the best investment decisions are. But this is something we've been doing for some time, and we generate a good return on this business. So we have a very strong retail business in Kenya, which we very much enjoy. I don't think if you were coming from outside and looking at investing in Kenya, you would want to invest in something where you have no presence at all. For us, we can invest and increasingly pivot our investment into things where we can add real value. JP Morgan is a top-tier global investment bank, and for JP Morgan to want to have the group of Kenyan clients, but also serve their international clients into Kenya, that makes perfect sense. We do that as well with our clients. Sometimes we compete with JP Morgan. Frankly, more often we work together with them, a very, very strong working relationship. That's the way finance operates these days.
All right. So despite making profits, how is Standard Chartered integrating the ESG principles into the operations in Africa, and what are the impact do you foresee this having in the bank's future growth in the region?
Yeah, but part of what we did with our board while they were in town was to expose them to some of our ESG initiatives. I think hopefully everybody knows about Future Makers, because that was the proud sponsor of the Nairobi Marathon just a couple weeks ago, I guess. So there were 25,000 Future Makers shirts that were running through town, and what a fabulous event that was, I must say. And Future Makers for us it's our sort of umbrella program for creating employability, in particular amongst less advantaged people, and in particular for women, so young women. So a big focus on education and getting prepared for the workplace. But we have many other programs that are some dual purpose sort of objectives. Like we have a program called Women in Tech, which is now a global program for Standard Chartered, but it began here in Nairobi. And this was getting a group of either women-owned or women-controlled or women-targeted businesses, usually with a tech flavor. We use the term tech somewhat broadly, but startups, and helping incubate these startups, helping mentor the leaders, bringing the sort of financial perspective to complement what is typically a super strong commercial perspective that they bring. We have put thousands of women and people through this Women in Tech program globally, and we're really proud to say that it started right here in Nairobi, I think 10 years ago. So it's just a spectacular, and so we gave our board some exposure to that as well. And we're always looking for new ways to make an impact on our communities, whether it's through financial literacy or charitable giving to an extent, but we think we can do more and have a bigger impact by through employee volunteering, through providing these mentoring services, through providing education services that will hopefully enable an entire generation to make good financial decisions, help promote businesses, and hopefully create more and more jobs for the local economy.
All right. And as we wind up, in terms of regional markets, the African economies, do you see particularly promising for investment over the next year? And how does Standard Chartered plan to deepen its presence in these markets?
Look, I think that the trends have been good for many of our markets in Africa. So commodity prices have been stable, and that looks to continue to be the case. The interest rates have been coming down, or at least beginning to come down. That's been very helpful. For the most part, currencies, which have been quite volatile over the past couple of years, have stabilized or improved or strengthened. And so that momentum coming into this next period is actually pretty good. We're optimistic about the Kenya economy, recognizing that it's been through a really difficult time.
So many African economies are facing debt and currency depreciation challenges there. and raising the risk rating. So how are you managing these risks when lending to sovereigns and businesses in the region?
Yeah, as you know, we have operations across the continent, and several of the markets where we operate have either gone through debt restructuring, so thinking in Zambia and Ghana in particular, or gone through periods of real stress in the past couple of years. And the first thing that we can do is prevention. So hopefully working in advance to help strengthen national balance sheets so that we don't get into the difficult situation in the first place. And I think we've been quite helpful in that regard, in sort of sending the warning signals up early on. But it hasn't always worked. And nevertheless, in some cases, countries have needed to go through a restructuring process, in which case we are very, very active participants in that process. And very active participants, of course, we take losses in those cases as well. And we did in Zambia and Ghana, just to pick the two countries that have actually gone through this restructuring. But part of our undertaking is to say, yeah, we'll take our share of pain, but we'll give you some honest advice along the way. And if you're in a position to take our advice, we'll be the first ones to help pull you out the back end by arranging new funding sources. Typically, that comes in the initial phases in cooperation with somebody like the IMF, or perhaps bringing some export credit agency or multilateral development bank institutions in together with us to help get the pump going again, to sort of prime the pump for money to flow. Of course, then as economies return to growth and stability, we want to be there to continue to pump life into economies that inevitably had gone through a very difficult time. I must say we've been in this business for 170 years. That's how long we've been operating in Africa, and different countries have gone through different periods of stress many, many times in our long corporate history. And I'm very happy to say that we've been a force for good as we've gone through that. It's not always painless from our perspective. It's never painless from the country's perspective or the people's perspective. But we work together. We help each other out. We come out the back end, and we come out stronger.
All right. Well, that's just about it. Well, thank you.
Thank you.
All right.